welcome back. Let's talk to Phillip Shaw. He's the chief economist at Investec. Phillip, welcome to the show.
Hi there.
All right, let's talk about the ECB and the Feds and monetary policy, rising interest rates. The Bank of England, from what I read and see, are in a bit of a pickle. What's your stance at the moment?
Well, the overriding background is that global growth is solid. And from at least a world economic perspective, a lot of the downside risks that investors were talking about 12, 18 months ago have dissipated.
Yep.
So, although central banks are at different stages of the monetary policy cycle, each central bank is considering either reducing the amount of easing or stopping easing or tightening further. So, if you're looking at it from the perspective of the Fed, obviously the FOMC has been raising interest rates for some time, but what it's now seriously contemplating and likely to go ahead with is reducing its QE holdings, perhaps from the fourth quarter of this year.
But that's a 4-year project, right?
It's a long project, and if you get periods of weakness over that, say, 4 years, then I wouldn't be surprised if the Fed calls a temporary halt to its balance sheet reduction plan. But yes, it's a very long-term thing. From the perspective of the ECB, of course, is still undertaking a QE program at the pace of 60 billion euros a month. What it is planning to do, we think, is to start tapering that 60 billion over the first half of next year,
right,
with the announcement coming, perhaps September, perhaps October. Now, each of those central banks is looking at a couple of headwinds to its plans. In the US, for example, CPI inflation has been relatively modest. It's trying to work out, the Fed's trying to work out whether that's just a short-term blip or it's part of a longer-term global trend. The ECB is probably looking at the value of the euro, not just against the dollar, but on a broader trade-weighted basis, and perhaps thinking, well, we don't want to do this too aggressively. Yeah. So a lot of it is about communication. We will hear both from the Fed and the European Central Bank this week in terms of effectively their minutes from their recent meetings, but the critical juncture, I think, in communications terms comes from the Jackson Hole conference in the States from the 24th of August, where both Janet Yellen and Mario Draghi are expected to take to the stage and give markets some monetary policy hints.
Right. A few words on Mr. Carney and the Bank of England. What's he thinking at the moment?
He must be thinking, thank goodness the Monetary Policy Committee didn't vote to raise interest rates in August. Yep. Sure, I can understand 100% why the Bank of England at some stage wants to raise interest rates, but doing or considering it in a serious way just when the economy has slowed, when wage growth remains very, very soft, in our opinion, is the wrong time to be doing that. So we're probably on hold for quite some time, certainly this year. And in fact, our central case is still that the MPC in the UK will not raise interest rates until 2019.
There was a couple of surveys out recently, 50-50 chance of the UK PLC going into recession. A headline on that? You think that's likely, unlikely?
Yeah, I guess the watchword from the great financial crisis is never say never to anything. But in terms of trying to calibrate the odds, 50-50 looks too great in our view. Difficult to put an exact number on it, but 10-15% just as a, perhaps a finger in the air. Don't forget, if we look as if the economy is going to weaken any further, you can get a response from the MPC. It could cut interest rates again, it could restart QE, and then you've also got the option that the government could take and perhaps ease fiscal policy, even though it might be reluctant to do that. If the economy were heading towards a downturn, and I don't think that we are, that could be the response from the authorities.
Understood, Philip. Thank you very much.